Today, we're going to chat about gas community and emerging for very, very exciting. That's something brand new. I'm Idar. I'll be your moderator today. I'm investor fund for venture funds. Actually started in 2015, so the early funds to invest in Web3 and crypto. Super excited to go a little bit deeper with you today on gas markets. So gents, maybe you want to do a quick round of introductions, and then we can get into it. Why don't we start with you?
Good morning, or afternoon. I'm Kevin from ETHScale, gas trading marketplace, and deep insights on gas management and usage. And we'll get into more a little bit later.
So Juan David from Kirok, so algorithmic trading, market making. Very excited to talk about the topic. We also do a lot of on-chain trading, so that's why I'm here.
Alan, I'm here for GSR, probably the oldest and biggest crypto native market maker out there. So we do on-chain trading and everything with crypto just to improve the accessibility and the quality of the markets.
Laszlo from Kill. So we are the leading rewards platform for other platforms so that they can offer rewards on chain, staking and DeFi. And we're also the largest independent Ethereum node operator in the world. Good to be on the panel to talk about gas.
Hey guys, my name is Artemi. I'm head of product at P2P.org, one of the leading staking and DeFi solutions providers. And yeah, happy to see you, happy to be here. Yeah, we operate like 7.5 billion of assets under management, so making us one of the leading staking providers out there. Let's wrap it up.
Let's do it. Awesome. All right, so thank you. So we got some real heavy hitters here on the financial side of things, but why don't we tee it off with you? Can we have the mic, please? Why don't you give us a little bit of an overview of the gas market today and where we are, just so that we're all on the same page.
Sure. So as of today, there is no market, but I guess there's probably two types of gas markets that we'd be looking at as an industry. And so from the base case, I'd call it like just general gas trading within derivative context or futures context. So this would be trading the base fee effectively and hedging its movement either upward or downward. And so technically we can do that through a mix of futures contracts, perpetual futures, or some other type of derivative instrument, I should say, on the base fee. Separate to that, there is the idea of inclusion in the next block, something that more a nascent topic, I guess, revolving around pre-confirmations or pre-comps for short. What this is that I can basically speak to well, not speak, but I can negotiate with a validator or a block builder to guarantee inclusion into the next block or like the 5th block or the 20th block. And I can basically buy, 10 of the 50 million block space from, like one of these guys at the end, basically. And so whether it's the physical delivery or the physical incarnation of gas, or it's the derivative trading of gas, these are probably the two facets, I'd say, of the gas markets that we will eventually see as, I guess, crypto's first, like, crypto-native commodity markets.
Got it. Very, very helpful. And so maybe we can just get into it and let's talk about if you want this, guys, and if so, why? So maybe we can start with P2P over here.
I mean, we are validators, we sell block space, so the more fees actually the better for us, but to sound not too capitalistic, let's say. So we see it moving towards a multi-dimensional gas fee market. So when we have a part of the market who very deep into DeFi and some real network usage, real hard network usage for separate market, and for some common users as transfers, as a separate fee market. So we see this as a nice evolution to general gas markets situation.
Yeah, I mean, we have, as you mentioned, right, gas is sometimes half, sometimes a little bit less, sometimes more than a percentage of the ETH rewards, staking rewards. The other part being the execution, the consensus layer rewards. So the more activity on chain, higher gas price is, better for node operators. As Kiln, we also build and deploy a smart contract platform for staking and DeFi. So we have conflicting interests there because when you deploy contract and gas is super high, or when you even deploy validated keys on smart contract and gas are super high, definitely not good for a business. It's a lot of high costs. and it's also terrible for the users, right? To have like high volatility and high gas price in general. So yeah, I think a market that can edge and flatten this volatility would make a lot of sense. That's kind of our view.
Got it. Makes a ton of sense. And then, so we got it from the validator side, kind of adds to revenue, makes a bunch of sense. Maybe we could chat hear a little bit from our financial players here, like kind of how do you guys see it?
I mean, there are multiple ways we can look at it. I mean, the first thing as a market maker, we make markets. So if there's an emerging market coming up, there's an opportunity for us to trade. That's the first thing. Then the second one, on-chain, because of the, let's say, not clear price of gas that moves all the time, it has some impact of some, let's say, proprietary strategy we are running. So having a bit more clear view what the cost is going to be to do transaction on chain, that's another helpful thing. And then the third one, I think there's going to be multiple consumer of gas that actually are looking for hedging solution that we will be able to provide and facilitate to them. Think about like oil and like airlines, just for risk management stuff. I think that's the three venues we can go down.
Makes perfect sense. And we'll come back to that point because that's what I want to go talk about. But I want to hear from Juan first. If you,
Yeah, so I mean, the way that we look at it is really that cost predictability is going to be a driver for adoption. So, you know, for us, what drove us to look into this market and start the conversation with Kevin was really the understanding on how does the business of somebody that runs a sequencer works. And for me personally, when we started to see that there are real companies with real revenue that are not just living out of VC money that depend on gas cost to run their operations, we started to realize, okay, this is going to be a constant need and it's not going to go away, correct? So the more predictable the gas cost can be, the sequencer, people that run sequencers, correct, which are, you know, Base, Arbitrum, all of the large layer twos, are going to have a more successful business. And the reality is that because Ethereum is becoming better, yeah, with every release, every time it becomes harder for them to generate revenue out of fees. So having the predictability is going to become more important as they charge less and competition continues to increase.
got it. That makes a ton of sense. And either Juan or Alain, maybe you can, could you walk us through like an analogy from Web 2? Because I feel this lends itself to very Web 2. Like how do people kind of hedge their gas costs in Web 2 today? Say like an airline or something like that.
Like in the commodities market?
Yes, just for the non-financial people in the audience.
I mean, this is actually like a surprisingly, this is a very, very big market. Like famously, if you have ever read maybe the book from Ray Dalio on principles, you probably realize in between the lines when you read that book that he made his fortune from helping companies like McDonald's to build predictable cost of chicken. Like, and it's basically the same. This is actually a really big business. Like when it comes down to it in traditional finance, treasury departments are in charge of negotiating with financial firms to build structured products for them to have predictability. Perps are not widely used in TradFi. More calendar futures with delivery as you need the asset, right? At the end of the day, you need the delivery. So if you need the delivery of the commodity, that's going to be the function that's going to be the most useful and most used in TradFi as well.
That makes a ton of sense. And I don't know who's the best one to answer this, but so the analogy to TradFi or Web2 or whatever you want to call it is pretty obvious, but there is a big difference here, which I think you point out, Kevin, and that is that the volatility is just like ranched up to another level, right? We're talking like 2,000% within, you know, within a year or so. So how do you square that? Does that work in a setting like this with gas markets, or is that a problem? Like, are the premiums for hedging this going to be too high for the average protocol or user, or do you think that's not a problem? And please, anyone who has an opinion on this.
So I mean, I think that when we looked at the problem of how you build a market on this, typically in any market, the real first question that we always try to answer is what's the price? How do you generate a fair value from an asset? For every asset, the vol of the asset is going to be one of the principal components of deriving the premium that you would charge for the asset. But also you need to just understand the price itself. Yeah. And when it comes down to this particular asset, I personally think that the reason that the volatility is so high is also just because the market's not there. So if the market would be there, most probably volatility would come down to rational levels. But even if you look at very, very volatile assets, demand for options in institutional level for these assets exists in crypto and is actually rather high. You don't see it in the retail space because options, let's say on chain or in centralized exchanges don't really have a lot of retail adoption. And that's predominantly just because there are products that are hard for them to understand, and retail just love to trade perps because it's basic and easy. Yeah. But from an institutional perspective, there is enough proof that there is demand for that. I think the premium from the assets is going to start to be very high, but a sequencer, a company that runs a sequencer, would have the willingness to pay. Maybe nobody else would at the beginning, and then as the volatility decays, the next user types would potentially start to have willingness to pay for the premiums.
I think if we look at how the market will evolve, perhaps, I think from kind of day one, where right now you have like the physical guys, right, delivering that gas, right? And then you have kind of like the end users. And so you have kind of your most fundamental gas buyers and gas sellers. And then I think on top of that, once you build the marketplace for the gas instrument itself, then the gas buyers will evolve, hopefully, I think, into market makers basically of gas, right? And then you have kind of your market makers on gas, and you have structured products and options and all these other things, right? And so I think for the physical market today, it's called like 5 billion spent in the physical market on gas on an annual basis, but that's only like the actual users. But then when you loop on top of that, the derivative number of users, you might have 80, 90 billion in turnover on an annualized basis. And then that's really, once these guys are trading that, then, as you said, the market will just become more efficient.
That will decrease the vol.
Yeah, and then the vol should or may decrease.
Yeah, I mean, I think the first hedging will just start with like future forwards and perps, just because there's no option volatility part in it. Options probably a bit less, but if you just look at Deribit vol index for ETH, for Bitcoin, everything else, it started probably 120, and now it's down to 50. So I think when we as a market maker are doing a good job, but bring actually the natural supply and demand for gas together, and then basically do our job in inventory management properly, the premium will just go down, that it actually works out. It just will take some time and some education, highly likely.
I mean, from a staking provider perspective, definitely it's super hard not to be able to predict your revenue according to like flattened growth or predictable growth. Because I don't know, over the summer, you have so many people minting NFTs and doing crazy stuff on chain, and suddenly, okay, your revenue goes up 30%, with actually your number of staked ETH not really growing, or the opposite. So hedging there has a lot of sense, so that we can predict our revenue 12 or 24 months ahead. On the cost perspective, right, when you run a protocol or an on-chain platform, as we do, it's the same. Why would it cost us 30% more or 30% less just because there are more people minting NFT on-chain over the summer? And again, for a retail perspective, volatility block massive usage and massive adoption. You can have a chain or use a chain. My mother will definitely get hard to use Ethereum in the first place. Now there's a kind of abstraction, so she can have a wallet without even knowing there's a wallet behind. But if suddenly she has to pay $10 or $20 for a transaction, and she cannot predict this, will be very hard for her to use any on-chain products. So even for paymasters, if there's a sponsor in the future, you should be able to know how much you're going to pay for the users you're paying for.
Thank you, very helpful. I think let's, Kevin, maybe you can just explain to us how this actually works. Like, what is the value chain of, say, like a gas market with the perps and so forth? And then after that, I want to get into a little bit about who are going to be the actual end users. But maybe you could talk us through that.
Actually, I just want to touch on one thing earlier, actually, on the paymaster side. So I think that's coming back to probably the earlier panel on like scaling. I think you mentioned paymaster, and I think that's one of the critical issues here. It's that the average user is faced with the volatile gas price, and like I don't know whether it's $1 or $3 or 20 to do whatever transaction that is. And so, from a infrastructure standpoint, once we have these gas markets, then I think coming to your next question, like who are the users? But basically you have like your retail user, and maybe they know how to manage it, maybe they don't. But then maybe you have like market makers or different entities who will be active as paymasters. So let's take either of these guys, they'd buy like 1 million of gas, they'd set up their own paymaster contract, and then wallets or different types of users can basically like subscribe, they could pay them like a fixed rate fee, they manage all the gas price volatility, and that wallet or those set of users then don't even need to care about the price from that path onward. And so
It will be the role of market makers to be in between the integrators of the platform that want average
gas fees that they pay for their clients. Do you think the market maker will have recurrent contracts with the wallets, for example?
If it's on-chain, it could be good possible, or they're just off-chain that we just provide the service and just manage, let's say, their gas treasury for them, whatever their need is forward. It can be done both, off and on-chain.
I mean, I think I think there is an overall consensus that this market could make sense. Maybe I do have a question for you, Ken. Okay, we've actually seen throughout the last, let's say, 5 years, a lot of people that did try this. I mean, this is something that theoretically makes sense. We feel that this could be finally a wave to bring this forward to the market. But you know more about this topic. So why everybody else has failed at building this market?
I'd say it comes down to micro factors as well as the market not being ready for it yet. Earlier on there were elements where you could kind of store gas like physically somewhere on chain, but it would basically clog the chain. It's like they shut that down. And so I think that was one of the first gas tokens. And then there were a couple of other incarnations where the market dynamics weren't really suited. Like you'd have like a TWAP contract where you're hedging gas price over multiple periods, but then that didn't really hedge your immediate gas expenditure. And so I think it's a function of building the right type of marketplace. Like, are we trading the per block unit of gas? Are we trading the real-time price of gas? Or is it like an annual price of gas? It depends who the players are going to be. And so for us, we're trading one real-time price of gas down to the millisecond, as well as like the per block price of gas. Coming back to an earlier note on paymasters, the other angle I think for these guys is, could they manage gas for end users potentially, right? I guess if there's a business there. But separate to that is,
That sounds tough, man.
yeah, there's a business. No, we're not involved. But I think the other thing is, could you do it? Could it be done for protocols as well, right? So let's take like a Uniswap where, hey, Uniswap, your users spend 20 million on gas a month. Could a foundation go to you guys and say like, hey, we'd like to have a gasless experience for our end users, but could you guys manage the vol so that they can create that gasless experience? And I think that'd be pretty cool.
The paymaster market, it seems that you won't directly be dealing with the users, but you will be dealing with companies' platform that are willing to pay for the users, or foundation, or that's right. It's going to be a B2B market at the end of the day.
Yeah, I would also say it's going to be B2B. It's a bit like the airlines. It's an airline taking over the hedging. It's not you as flyer that needs to do the hedge. And I mean, there's KYC, AML stuff, but I think us as market maker working with treasury protocols or development company just to organize certain contingent and hedge it, easy. Yeah, so that actually the gas is outsourced to us and they focus on developing the product.
No, that's perfect. That was stealing all my thunder here on the questions, but that's great. So essentially, yeah, I think, so that makes a whole lot of sense, right? Like how are we, or you look at the consumer landscape today, people don't really pay for their own gas, like on airlines, they don't kind of pay fuel surcharges, right? Like Kevin, how does that actually look in terms of storing the gas, right? Or like, what is the instrument here? So you've kind of created like a perp, right? And so we'd love to understand, just like, if you could just quickly explain to us how that actually works in terms of storing gas.
Sure.
And then I would love to hear from you guys your thoughts and if this is the best instrument or vehicle in order to store that gas in the way that you're proposing here at ETHScale.
Sure. So there's, I'd say there's two ways to store gas. One is, so again, there's a physical market for the physical delivery, and then there's like a derivative market. And on the physical side, so if I bought a million gas units from one of these guys for 5 blocks ahead, if I don't use that gas, that's gone. So like I just default on that gas. I could sell it in a secondary market, right? So I could buy a million gas and sell it 3 seconds later if I wanted to. But I couldn't store that physical gas in that context there. As a derivative, however, we could also go long, short gas on different blocks themselves. But as that rolls down, as calendar futures, those would traditionally get expired, and you'd kind of net settle on that. But what we have is a perpetual contract where you can effectively just roll that over. So you could rely on us to roll over that derivative contract for you, which is effectively storing that gas. Or you could just do it yourself. You could just trade and keep rolling that contract day by day by day, or 2 days at a time, whatever it might be. But I think through the derivative market, and either perpetual or just rolling it itself. That is like a synthetic storage mechanism, I'd say, of gas.
Got it. And yeah, would love to hear from kind of.
Given the two options like physical and derivatives, so I think the derivatives is more appealing, at least from our side. But my main question: so you're going to introduce like a derivatives exchange, like to make a derivatives exchange and introduce futures on gas. So eventually, at some point, you can have like a market manipulation opportunity. How can you cope with this?
Yeah. Okay. So this is it's an interest. This is the core of, I guess, how blockchains are designed and whether they can or cannot handle gas markets. And so the dynamic here is currently, like with MEV or MEV, like you can basically front run or I guess back run, or you can basically like insert trades into a block, and pay higher tips to kind of push someone else out. But the dynamic here is that I could go long, like $1 million of gas. Right, I could go long $1 million of gas, and I could just stuff garbage into the next 10 blocks to drive up that price of gas, right? So this introduces the concept of like MEV, like outside the block, is what we call it. How do we manage that? We have no quick solution. I think the best thing is slowly going to market and building the right relationships and having the right dialogue with people to see how we do manage it, because it might be something that the Ethereum Foundation needs to address down the line. So in this context, I could buy $1 million of gas. I could pump the price up in the physical market, and that creates a lot of scarcity, and I make money that way. Another way is in the physical market, I could hoard and buy all the physical gas so that none of the transactions go through, right? So I could effectively buy up the next 10 blocks of Ethereum, and for 2 minutes, Ethereum is stuck, right? And like no one can do anything. And like, what is the price to that? Or if I'm a block builder or someone else, like again, it introduces all these dynamics from the real world, right? Like if I was to buy like corn or energy or chicken, and McDonald's can't sell chicken nuggets, whatever it might be, like it is some of these dynamics. But yeah, we don't have a quick solution, but I'm keen to engage with.
In that case, do you feel you'll be able, through the DAO, for example, to kick out the bad actors, or how's it going to happen, right?
In a permissionless context, no. In a permissioned context, like potentially. But from another perspective, are they bad actors, or are they playing within kind of the rules of the game? It's like MEV guys, like you can't really kick them out because they're playing by the rules of the game, right? I mean, I shouldn't say game, right? But they're just trading.
I'm not going to comment on the manipulation part because it can be a game or not, but I think if actually that commodity really gets established, the market becomes larger and larger, and that's just by the adoption itself, it will get harder and harder to do the manipulation. Yeah, the more player you have, the more established you get, the more people use it, and the more natural buy and seller comes together, the harder it's going to be to fuck around in the market. At the beginning, it's probably going to be a bit tricky, and you need to have more intervention.
Yeah, well, I was going to say that right now there's a huge informational advantage that institutional players have, and it's basically you're looking at the mempool and real-time information of gas, whereas like your retail person, they see gas prices update every second, every block, and they don't really understand that market. And so if on our website we have the real-time price of gas purely to educate your retail user exactly how this market moves. But I think to your point, the more people that trade this market, the harder it will be to manipulate it. But there's still some fundamental questions where at the fundamental level, like the validator or the proposer, they could choose whatever block they want, right? They could choose an expensive block or a very profitable one, or they could short the gas markets and they could choose a block with like nothing in it. Right, so it's an interesting dynamic. We'll need to see, but there's this physical nature is
Lots of exciting uncertainty here to unpack. I think one question that I had that maybe this is for the market guys, but essentially, and maybe this is totally off, but so gas is denominated in Gwei, right, or Gwei, and Gwei is essentially Ethereum. So why, or is it better to have like a separate unit to trade this as like, hey, what they're creating here, as in like ETH gas, like a unit of gas, or why couldn't you just like trade Gwei directly underneath and kind of hedge through Ethereum, given that because it has this aspect that it does that physical goods don't have, in the sense that it actually doesn't need to be delivered. right? Like it's fungible, not like oil that needs to be put in an airplane at a given time.
That's a design question, correct? I mean, that's just how Ethereum is designed. You have to deal with it. Outside of Ethereum, there are some blockchains that are playing with implementation of things that work like you're describing to try to see if they could make the market of gas less volatile by decoupling it from the underlying asset, the underlying chain. And then, I mean, at least from the implementations that I've seen that I think could make sense, what you would do is that the core asset, so let's say Ethereum, would natively constantly pay a yield on a gas token that is used to pay, but that gas token would expire. Kind of like it would be like a real commodity that like would decay, and therefore it's not that you can infinitely generate more gas by hoarding. You would have like a curve where you get to a point where your new unit of gas gets generated at the same time that your last one disappears. So basically you, let's say for the sake of simplicity, all the time you have 100 gas in your wallet because you're holding 100 Ethereum. So it gives you a capacity for you to transact. But if you need more gas than that constantly, you need more Ethereum as well. I think that way you could decouple the speculation of the gas. But I mean, at the end of the day, it's a design choice of Ethereum, and unless they change it, we have to deal with that. You know?
Got it. Great. So I think we're on time here, but wanted to thank you guys for coming up here and talk about gas markets. I think it's super exciting, and yeah, let's give our panelists a round of applause.